I'll just pick up from where Apurva and Anshu left off. So if I were to just dial back to 2 years ago, right, what we basically saw was a widespread economic crisis. And I think like Ramraj talked about right in the beginning, the intent was to help the largest number of people with this smallest amount of resources that unfortunately was available, right? So the question we were asking ourselves is, how do you take what's available and really stretch that rupee to the greatest extent possible to unlock a lot of other resources that exist within the private sector to benefit the largest amount of people in a way that it's ultimately sustainable? It's not like philanthropic capital is going to be available forever, right? So we wanted to ensure that it was truly catalytic. Evans, if you can go to the next slide. So as we were thinking about the pandemic, we were very, very focused on the workers and micro entrepreneurs that form the backbone of our economy. They're largely informal. And, part of the reason that the pandemic hit them so hard is because of their informality. So we wanted to keep a few things in mind. And, this was really designed with those workers and micro entrepreneurs that we were supporting. The first thing we heard time and time again is that they did not want charity. They said, we never, really extended our arms looking for help to anybody else. Yeah, we are going through a crisis. So if you're able to support us now, we will bounce back on our feet and we will support somebody else. So keeping dignity at the center of how we were designing these solutions was critical. Second, the speed was very, very important. With every passing day, there was just, more loss, right, that all of us were seeing. Third, in some sense, I think the one positive silver lining was that a lot of it had to be delivered digitally. There was no way to deliver these services physically. And so a lot of what Revive has done has actually just been digital delivery of services. We wanted to ensure that we were not just focusing on recovery as part of the pandemic, but also thinking about resilience and growth and how do you systematically move people into the formal ecosystem. And then the last thing that Apurva talked about is that we needed to customize it, right? What a farmer needs is inherently different from what an artisan needs. It's very different from that kirana store below your house. And so we needed to ensure that we were constantly customizing these support mechanisms depending on the individual that we were looking to help. As we spoke to funders, right, sort of classic scenario, limited resources, lots of requests for that limited pool of money, needed to respond quickly, had to be compliant. The regulation was changing. It continues to change as we speak, and many competing priorities. And as we worked with the NGOs, they themselves were facing a shortage of fund, and they realized that relying purely on grants was not enough. They're actually finding mechanisms that give them a leverage, use the same money to support a larger number of people was going to be vital. But we also wanted to ensure that we were building on their core strengths, which is really strong relationships with the community, existing programs that were going on. And so the intent was to create blended finance structures that would just plug into the existing delivery models of NGOs and wherever possible, move them towards sustainability, right? Because I think everyone was reliant on money that wasn't necessarily available. And even going forward, just the need is so much larger than what's available. Evans, next slide. So while Revive initially had a very modest ambition, we said it'll be a 30 crore fund, we'll impact maybe 30,000 people over a 2-year period. We're already at 175,000 people impacted. It's a 175 crore fund, and we're looking to scale up very rapidly to 10 million. So the ambition right now is to irreversibly increase incomes of 10 million workers and micro entrepreneurs. Why workers and micro entrepreneurs? Because they form the backbone of the economy. We're already seeing a K-shaped recovery. We can't afford to do that, right? They have to really experience the benefits of all of the economic growth that the country is currently experiencing. Why income? Because ultimately that's what matters. And so we did not want to hold ourselves accountable to things like reach, etc. We said, if we're not increasing incomes year after year, we failed, right? So it was a very serious commitment that was fully aligned to the aspirations that our participants have. By the way, we don't call them beneficiaries, we call them participants because they are, eventually it's about them, right? We can facilitate, we can catalyze, but it's their destiny in their hands. What we realized fairly quickly was access to finance was a key enabler, but not the only one. And so we wanted to ensure that we were bringing everything that we could to this individual as they think about their livelihood journey. So we use 6 interventions: access to finance, Social Security, because for a large proportion of them, there are government schemes available. They don't know about these, right? The third one was really digital empowerment. I mean, think about that Kirana store. If they weren't able to take your orders on WhatsApp and they weren't able to accept Google Pay, you are not buying from them anymore. And so because a large number of businesses needed to be digitized, we said that that's a critical intervention and we will use the right digitization mechanism depending on what that business looks like. Enterprise development was critical, market linkages. If you don't grow your customer base, you're not growing as a business. And then also ensuring that wherever possible, we're providing trade-specific skills. And then particularly for women workers, also investing in healthcare, sanitation, and nutrition, because these are key barriers. So today where we are is we have about 27, 28 funders, 21 implementation partners. That list is growing very, very rapidly. And we brought funders together in a way that we were playing off of the strengths and ambitions of each one. So the 5 key funders that really got Revive seeded up were USAID, the British High Commission, AMIDR, MSDF, and UNDP. And just to give you a sense, MSDF first came in with an initial anchor funding of 2 crores. We were able to raise 87 times that money, right? So truly catalytic, but allowed us to build really the teams, the network, the framework, the compliance model to really scale this up. The second set, which was very, very important for us, were companies that were invested in the success of their stakeholders. So Godrej, for example, came in and said that the large number of beauty parlors that actually sourced from Godrej were in trouble because, you know, there was a shutdown, right? And so we worked with Godrej to ensure that we were supporting women beautypreneurs. HDFC Capital came in and said, well, there's, you know, millions of construction workers and contract. And so we worked with HDFC Capital. The advantage with working with companies that are interested in their stakeholders is that they are already going to support these individuals in the long term. And any support that we offer is then truly catalytic. And they understand their stakeholders extremely well. And therefore, the ability to co-create what that program should be, how it should be delivered, how do you measure outcomes is very aligned. And really we build on their strengths. We also partnered with Google, Microsoft, LinkedIn, because again, you know, digital transformation was a key enabler. And all of these companies had the ambition to say, how do you really digitally transform 10 million, 20 million, 50 million lives, right? So very, very aligned with your own objectives. And then I think what was wonderful in terms of having funders like IIFL, HSBC, and others come in, is they were willing to say, hey, if, you know, the Godrej cohort needs support, we can layer on our money to them. Or if you think that it's more important to invest in returnable grants versus pay for performance or interest subvention, we have the ability to do so, right? So flexible money that came from other CSR really helped us scale up a lot of the work that, let's say, the stakeholder-focused organizations were doing. We partnered with all kinds of implementation partners, and they were so core to all of the impact that we've achieved. We worked with MFIs, NBFCs. The NBFCs that we worked with were primarily sort of fintech NBFCs because we needed to reach communities across the country. It had to be done digitally. We worked with some of India's largest NGOs, so Pratham, Vritti, Tisar, Seva, etc., are all you know, really integral to the success of what we've done, and I'll talk about that in a minute. We worked with a large number of service providers. So, for example, we're supporting 85,000 small retailers across India, and that's happening with SnapBiz and MSwipe. These are regular private sector companies, but really the reach that they have, the resources, the speed was something that we truly wanted to build on. And then we work with technology partners because if you think about irreversibly increasing incomes of 10 million workers and entrepreneurs, with 200 partners, you really need technology as a key backbone as you build it all up. Evan's next slide. So this is the ecosystem that I talked about. Everyone had a specific role to play. You know, the work with donors was meant to be truly catalytic. It helped us build out the foundation of Revive, very similar to Himanshu's experience. Our corporate partners, we ensured that this wasn't just a, you know, one size fits all. What we did with IIFL was very different from what we did with Arvind, was very different from what we did with HSBC. The intent was to align with each one's priorities, their stakeholders, the regulations that they have, you know, the constraints, their needs, their aspirations. So this was really, I mean, I think a lot of the success came from customizing each intervention to not just the needs of the participants, but also what the funders wanted and what the implementation partners were okay with. I talked about the work with NGOs and service providers, and we're now beginning to work extensively with the government, particularly the National Rural Livelihood Missions and the National Urban Livelihood Missions, because the government has a similar ambition. They want to really financially and economically empower a large number of Indians who've been left out of the formal financial ecosystem. And therefore, the intent is to really build on the core competencies and large networks and extensive work that the government has done across the board. Evans, next slide. So here are a key sort of guiding principles for us, right? The first thing that we learned, it wasn't rocket science, was when we worked with these workers and entrepreneurs, they said, well, you know, you guys had one crisis in your life, right? You had the one pandemic. We go through a crisis every day. And so unless you're going to be able to help us, not just at one moment in time, but across the different opportunities that we encounter, but also the different challenges that we face on a day-to-day basis, you're not going to see us really prosper. And therefore, we knew that going forward, we needed to use multiple interventions. So it can't just be the one thing. We needed to bring every single instrument that we have to really create that transformative change. We also knew that we needed to do this across their life cycle, right? So Revive right now is investing in an individual over multiple years. Somebody takes a returnable grant, pays it back, they then get access to a low-cost loan, they pay that back, they then get access to a regular loan. But in addition, they're getting skilling support, they're getting social security, they have market linkages, LinkedIn is coming in and training them via our mentorship network. So the intent is to stay with this individual and continuously give them more and more support as we move forward. And therefore, we're not counting outputs, we're really counting impact, right? And impact takes time to be able to, truly kind of manifest. The second thing that we are holding ourselves accountable for is really the graduation of people into the formal banking sector. We're not an MFI, we're not an NBFC. We don't want to keep lending to the same person over and over again. We want to make sure that the person goes from being supported by a loan shark to being supported by an MFI, to being supported by an NBFC, to a bank, so that eventually he's able to get the lowest cost of interest that's available to him. We also want to ensure that they are part of the formal sector, right? So that artisans are able to sell on Amazon and Flipkart, that people become part of corporate supply chains or government supply chains. That's the only way to break out of this, the poverty trap that a lot of the small businesses find themselves in. The third is to really create public goods, and I'll talk about a few of these in a minute. The next is to continuously skill people, right? So we're doing a lot of work in skilling. Like all of you have seen the ecosystem moving steadily away from free skilling that's being offered to fee-based skilling. Now, remember, when a person enters the job market for the first time, not only is he first to income, but he's first to credit. And do you imagine that any NBFC is going to lend to this 18-year-old who's trying to find a skilling loan? Yeah, most likely not. So we also want to ensure that not only are we supporting people the first time they want to enter the workforce, but you know that this generation is not going to stay on in the same job. They're probably going to start working, then they might become a gig economy worker, then they might start their own business, they may come back into the workforce. And so we want to ensure that we're constantly upskilling, reskilling, so that each individual is able to maximize their own livelihood potential. And the last is, like I said, technology is at the core of it. We use it for tracking, we use it for delivering these multiple services. We really use it to understand who we're dealing with and what else we can bring to them. And also to, from a funder's perspective, ensure that there's complete transparency. You know what's working, you know what's not working. Evans, next slide. So I want to spend a little bit of time on this, given that we're talking about blended finance, right? And what Himanshu talked about is really the ability to support social enterprises in systematic ways. Now, Revive complements that very well, because we are actually interested in not just the enterprise and the NGO that we work with, we're also very, very interested in the individual, whether he or she is a worker or an entrepreneur. So what do? We use grants for those that are the most vulnerable. So if you're supporting sanitation workers, none of this fancy stuff works, right? They really need grants right now to be able to figure out what else they can do. But if you're working with street vendors, they have the ability to take a returnable grant. which is a zero interest, zero collateral loan-like instrument, and pay it back. And we've seen 97% repayment rates with our returnable grants. What we're now doing is we're saying every individual who took a returnable grant, used it well, and paid it back, can we capture that information almost as a pre-credit score? So when we first began REVIVE, we had no idea whether returnable grants would work or not, right? People said, oh, maybe you'll see default rates of 20%, maybe you'll see default rates of 80%. None of us expected it would be 97% repayment rates. And so what we discovered is that a large proportion of people who we supported in the middle of a crisis actually were very good borrowers. And then we started going to NBFCs and banks and we said, will you trust this data about somebody who doesn't need to pay you back and still wants to pay you back? And we saw a lot of interest. So now what we're doing is we're beginning to collaborate with CIBIL and a bunch of banks and NBFCs and others to co-create a pre-credit score, which uses data and repayment behavior on the returnable grant as a proxy for this person actually being a good credit worthy borrower, right? So the person gets a returnable grant, she uses it, she pays it back. It helps us create a pre-credit score. We're now beginning to put together a credit guarantee facility so that the first formal loan that she takes from an NBFC is backed by a risk. So we're going to NBFCs and banks and saying, trust the pre-credit score, but because it's not proven yet, here is a risk guarantee which allows you to lend to this individual. And so the credit guarantee allows the person to come into the formal financial ecosystem for the first time. Remember, they're actually trained. They know how to take a loan, they know how to repay it back. The financial institution is comfortable. They've actually seen these transactions. And therefore, everyone is feeling better about this person being a good potential borrower. Once the credit guarantee is used to ensure that the first loan is given, after that, we withdraw the credit guarantee because now the bank or the NBFC knows the borrower. They no longer need any kind of catalytic support, right? So with small amounts of money, you've actually transitioned someone to the formal financial ecosystem. Now the banks work, they do what they do, and you no longer need a credit guarantee. The second thing that we're doing is because each of our participants don't just get access to capital, but they actually get livelihood inputs, right? So better training, more market linkages, just better enterprise development support. The banks really like us because they're saying, hey, your borrower is not just coming with a loan application, but they actually have all of these inputs that hopefully make them much better borrowers, not just today, but over a period of time. And so therefore, the relationship with the bank is actually bringing a set of people who are not just good credit, but are far more likely to grow in their business going forward. The third reason this is exciting is because, there are pools of segments that we are focused on that no one will lend to. So for example, we went to lots of NBFCs and said, would you lend to a micro contractor who works on a construction site? And the answer was absolutely not, right? They're migrant, we don't understand their cash flows, it's primarily a cash business, we don't want to lend to them. So what do we want to do? Do we want to support all the X million people who are in the construction sector? No. What we want to do is we want to use a credit guarantee to support maybe the first 500,000 or the first million. Enough for a set of banks and NBFCs to build a credit risk model that allows them to lend to a segment that traditionally they would have not lent to, right? So the intent is not to have a credit guarantee for every Indian who's looking to enter the formal financial ecosystem, but enough of those that it allows the financial markets to get a sense of who these people are and therefore lend to them even without our support. So at every point in time, our intent is to use philanthropic capital to unlock the most amount of money and get out as soon as markets start functioning, because then they don't need us anymore. In some cases, we also use interest subsidies, and we use them primarily for people who are just beginning their business or where businesses take time and cannot absorb the 20-25% interest rates that are currently being discussed. But as much as possible, we don't like the interest subvention too much, other than to a certain set of borrowers, because then the business gets used to much lower cost of capital, which is not sustainable over a period of time. So it's great to use at the beginning. It's great to use for businesses that are in a crisis. It's great to use for certain kinds of businesses, but it's not a facility that we think everyone needs. Evans, next slide. So I'll just dive in a little bit more in terms of the returnable grant and the interest subvention. So a returnable grant it's like a loan. It's a zero interest, zero collateral, pay if you can, pay what you can instrument. It's typically meant for people to get back on their feet. There is no legal obligation. There's a moral obligation to repay. Very, very easy and flexible terms. I'll talk about that in a minute. It helps them borrow, but also pay back if they want to. If they don't want to pay back, that's okay. But given the repayment rates that we've seen, it's really a great demonstrator of their credit worthiness, right? Why do we say it has a 5 to 7x multiplier? Because the same returnable grant can continue to churn. Somebody takes it, they return it, it goes to somebody else, it comes back, it goes to somebody else, right? And so over a period of time, even if you have about 90% repayment rates, you're still able to impact somewhere between 5 to 10x the number of people. We use pay across the board. So similar to Himanshu, we did an interest subvention where we said, particularly during COVID, and these were first-time borrowers who could not take on the 25% interest rates. So we said, when you pay the third EMI, we'll give you a tiny grant. When you pay the sixth EMI, we'll give you another grant. And so we did two things. It obviously allowed us to reduce their overall debt burden, but it also helped create good repayment behavior that then made them good borrowers. We use pay for outcomes for retailers. I'll talk about that in a minute. But broadly, everything that we did was CSR and FCRA compliant. We really played around with the returnable grant. So we said, it can be given as cash, it can be given as vouchers, it can be given through NGOs, it can be given through NBFCs, it can be given directly to the individual, it could be given to an NGO, it could be used as a standalone tool, it could be combined with other skilling interventions. But ultimately, we wanted to see what's working and what's not. And I'll talk about the success in just a minute. So here's everyone that we actually funded, and I'll just give three quick examples. So farmers got returnable grants just before harvesting season. They used it to buy seeds and fertilizers. They paid back when they sold the harvest. Retailers got it in a different format. So we found that a large number of retailers did not have POS devices or didn't have any digital tools. And so we said, here is 1,000 rupees. It's a returnable grant. Use it to actually get the POS device. If you like it, pay it back. We've seen 100% repayment. And then we said, if you clock 1 lakh rupee of transactions, which are digital, we'll give you another 1,000 rupees. But that wasn't the point. The point was, as soon as they clock 1 lakh rupee of transactions, a bank is actually able to lend to them, because now the bank has visibility into their books, whereas this was a cash business before that, right? So 2,000 rupees, 1,000 of which is a returnable grant, which keeps coming back. So technically 1,000 rupees, which is unlocking the ability for this retailer to not just now get access to bank and NBFC credit, but also, because they are digitized, work with Amazon and Geo and work directly with FMCG companies, because their business itself was transformed, right? So 2,000 rupees of philanthropic capital, really bringing a retailer into the formal ecosystem in a way that was just not going to happen without that support. For women workers, we used it in many, many different ways. So women who had lost jobs, needed to get reskilled to enter the workforce, we said, here's a returnable grant, pick a skill of your choice, pay it back when you actually start working. Women street vendors, here's money, get your card started, pay us back in smaller installments over a period of time. So really customize the loan or the returnable grant in various ways. There are broadly three kinds of. One is, first to credit and first to income. So this is your classic 18-year-old wanting to take a skilling loan, but has no income, right? First to, has had income before, has been borrowing from informal sources, and therefore first to formal credit. And then, also first to income, but not credit, right? So we want to ensure that the way we work with each of these is also distinct, and that we're responding to each of their contexts very specifically. Evan's next slide. So this is sort of the success that we've seen, right? And this is really based on, and I don't think you can see it, but if I'm happy to send you the presentation later on, but we supported entrepreneurs with disabilities, we supported tribal communities, blue collar workers, retailers, the textile industry, beauty industry, farmers, artisans. We did skilling, we did retailers, we did just smaller micro businesses, construction workers, right? So a large fragment of people in various ways. We saw the repayment amongst beauty entrepreneurs. These are women who ran salons. And then the highest in terms of farmers and small retailers. I think our learning was that depending on how COVID impacted your business, repayment rates varied. If you were running a salon, you went through multiple shutdowns, clients couldn't come in, you kept buying products, they kept expiring because business was just starting and shutting. Whereas for farmers and small retailers, they were fine, right? Mostly. So very strong correlation with the impact of COVID on someone's business. The second thing, which was very, very interesting for us, is NGO. So cohorts supported by NGOs without any financial literacy support did really well. And we realized this was because they had such strong relationships with the NGO. So when the NGO field worker went and said, hey, your repayment is due, they were far more likely to actually see that repayment. So we found that, investing in working with NGOs that had really, really strong, trusted relationships on the ground meant that all of our outcomes were much better. As you can imagine, everything was flexible, right? The way it was tailored for a farmer, very different for a retailer, very different for a worker, very different from a street vendor. So the fact that we were able to customize everything really went a very, very long way. And then the last is now everybody who's got a returnable grant will now qualify to potentially get low interest as soon as we have a credit guarantee facility in place. So those that got just money in hand and we said, you can do whatever with it, had a 97% repayment rate. Those where it was linked to a voucher. So we told farmers, you can only use it for seeds and fertilizers. We told retailers, you can only use it for this digital tool. We saw 100% repayment, right? Now, it's fine when you're talking about 20,000, 50,000, 100,000 people, right? The question is, what happens when you scale this up to 1 million? Do the same trends apply? Or do you see vastly different trends, right? What happens when you're not giving in the middle of a pandemic, but it's life as usual, right? So all of these are things that we're looking to discover fairly quickly. Evans, thanks. Yeah, so actually maybe before I go there, Abhinav, if you're here, do you mind turning your camera on?
Yeah, hi Priya, I'm around.
Yeah, so I wanted to invite Abhinav. Abhinav is from MSDF. MSDF was the first organization that actually believed in the returnable grant. Actually, the returnable grant was co-created with the MSDF team. It came together in like a few days. And they have been sort of champions of this from the very beginning. They've seen it from Revive being only a returnable grant facility to now Revive having this sort of big blended finance ambition. So Abhinav, I wanted to just ask you to talk a little bit about your experience with returnable grants and Revive. And also, there are a lot of HNIs and foundations on, in this meeting. And so if you had some guidance to give them, what would that be?
Thanks, Priya. So as Priya has covered in her presentation that what was the initiation behind the Revive Alliance, when we started, this was deep in the time that COVID had hit and lockdown was there. So the real intention behind starting such a facility was to provide working capital or to provide capital to people who were impacted by the lockdown. Their livelihoods were hit, and to provide them some sort of capital to get back on their feet. Now, the uses of capital could have been multiple. It could have been for consumption expenditure. It could have been for working capital. It could have been for a number of reasons that they needed capital at that point in time. So really, we didn't define a use for the capital at that point in time. However, when we set up this facility, there were 2 or 3 reasons that you needed a catalytic funder or a philanthropic funder to come in at the start. And let me cover those reasons. Why you need such catalytic or anchor funders to come in and believe in such a facility. One is, in terms of such times, as Priya has also mentioned during the presentation, people believe that the repayment rates will not be very high. People believe that there will be high delinquency. So you needed someone to cover that delinquency. You needed someone to believe in these communities and to understand that if something goes wrong, there is some capital at the back of it covering for those things which can go wrong. So for example, there was an initial, and Priya didn't mention this in her presentation, but there was an initial first loss guarantee which was set up during the initial phase of Revive Alliance. But fortunately, it never got utilized. Why did it never get utilized? It never got utilized because we saw such high repayment rates, as Priya mentioned during her presentation, as high as 97% on an average, that we never needed to utilize the first loss credit guarantee. However, in order to leverage the other capital that is available in the market, whether it was the CSR capital or whether it was the market capital, you needed some catalytic funders to believe in such a blended financing facility. Second, in terms of providing experimentation capital, because some of these instruments were being looked at for the first time, the Revive Alliance or a returnable grant is very similar to, if you can imagine, a pay forward scholarship. It has been in existence for a long time, but it has never been tried in the commercial sense or at a scale that the Revive Alliance was thinking about trying it at. Hence, you needed some of the anchor funders in terms of philanthropic capital to back it up. The third and the final reason that you needed some philanthropic capital was that the CSR and the other forms of capital that came into the picture, they were looking at impacting the beneficiaries that were directly associated with them. But someone had to fund the back-end costs. Someone had to fund the cost of the team, the cost of running the alliance, etc. That's where philanthropic capital or catalytic capital came in very handy, and helps provided them the leverage or the confidence that the 100% of the capital that they provide will be utilized only for the beneficiaries or customers or participants, as Priya was calling it, which they want to send their capital to. Now, in terms of other HNIs or other foundations looking at it, I would say that there are 3 points that you should look at. One is, where is the capital best used in forms of different alliances? So for example, why I say that is that there might be multiple blended financing facilities. And these days, what I've also seen is that in certain cases, blended financing facilities are being force-fit. So it's not necessary that a blended finance or a pay for performance facility may be the best instrument out there for you. So as an HNI, as a foundation, you should evaluate what is the leverage you're providing. Are you coming in as a catalytic funder, or are you coming in as a funder which is impacting a particular set of beneficiaries? Once those objectives are clear, a blended finance or a pay for performance or these sort of instruments work very well if the objectives align with what you're trying to do. The second and most important thing that I would request you to look at is the time frame and the kind of fund size that you're looking at. Sometimes what happens is that the disalignment or the misalignment of the fund size or the time frame. Typically, a blended finance facility will be like a J curve. It'll be slow initially, but once it picks up, it'll pick up very, very fast. And the returns and or the outcomes that you can achieve through such a facility will be multifold of what you can achieve on any other facility. But you'll have to be patient. And that's the reason you also call some of the philanthropic capital as patient capital in this part of the world. So having said that, once you've realized that the instrument is a good fit, ensuring that it is designed in the way that you want the outcomes to be reported to, you want the outcomes to be played out to, it works very well. And with that, Priya, I'll hand it over to you. Happy to answer any questions that you might have.
Thanks, Abhinav. I just wanted to now turn to Soumya, who's also here. Okay. So I think, Soumya really has been a champion of blended finance, and she was one of the first really, CSR champions to come in and look at various aspects of what we were doing with Revive. So Soumya, if you can talk about, just your experience of using these blended finance instruments. I know that there are more that you're currently looking at, but also what did it take to get internal and external alignment? Because there are many stakeholders, right, that you had to convince. And so just talk a little bit about that journey, and, maybe the other CSR folks on the call can learn from you.
Thank you, Priya, so much for that introduction. And thank you, IBFC, for having me as part of this masterclass. Priya, if you remember the first time I tried to explain blended finance to someone senior, they had said, why are you putting an elephant on the mouse? Do you remember that call I made to you saying? Anyway, so a pleasure to be here. Just quickly, in terms of my background, I spent about a decade in technology with General Electric in the US, and then crossed over to the social sector about 15 years ago to lead CSR portfolios for multinationals like Genpact, Godrej Industries, and now IIFL Wealth and Asset Management. And perhaps it was my Six Sigma training, but I like to believe that I've been passionate about driving effectiveness and efficiency in funding, whether philanthropic or CSR, for several years. And in fact, I had the opportunity to co-author a report along with Priya's team on catalytic CSR in 2019. So thrilled to be here today. The IIFL, just as to call out, the IIFL Wealth Foundation is a relatively young CSR foundation established just before the pandemic, not to be confused with the parent foundation, which is also the IIFL Foundation that's been around for a longer time and does not participate in blended finance yet. So as I had a unique advantage, I'll be honest, while setting up this, the foundation. As a company, IIFL Wealth and Asset Management is very entrepreneurial and is constantly innovating to maximize financial return for clients. So, similarly, for the foundation to believe in maximizing social return was just followed logically. One of our founding philosophies was to pioneer and participate in innovative CSR compliant blended finance instruments, much like the ones that were discussed on today's masterclass. So along with like-minded partners like Revive, we reimagined traditional grant giving and evolved a more catalytic approach with our CSR funds, deployed to generate a higher social return by either unlocking further capital, recycling funds, and a much stronger focus on outcomes. So we vetted and co-curated blended finance interventions that maximize impact and almost enabled a multiplier effect to every CSR contribution made. The word multiplier effect to every CSR contribution made, or exponential impact, is really what got a lot of our internal stakeholders excited when I was pitching this to them. Being a BFSI, thematically, we prioritize financial inclusion and access to finance as a lever for livelihoods, but we weren't limited to any particular sector, as Priya alluded to earlier. We also, in the spirit of what Priya said earlier, we were also aligned and we believed in, long-term holistic solutions. So, you build skills and capacity, throw in market linkages, but overlay that with financial literacy and inclusion, investment, saving advice, incentives, access to capital, etc. So our ethos was to build the necessary bridges between informal and unorganized sector and formal sources of credit. And much like the aim of the Revive Alliance, we hope to nudge vulnerable and marginalized communities towards formal lending and banking channels. So having given that background, last year, which was year one for us, we participated in CSR compliant instruments like returnable grants and interest subsidies linked to pay for outcomes. Also an incubator for inclusive lending startups that received grants for first loss default guarantees. The Revive returnable grant cohort that we had chosen to participate in was with Industry Foundation, and it provided cash flow and access to working capital to 1,250 vulnerable women artisans in Tamil Nadu. Needless to say, capacity building support and access to raw materials and market linkages were also provided. And the Revive cohort for the interest subsidy or interest subvention linked to pay for outcomes was in partnership with IRREVERSIBLY, where financial literacy coupled with incentives for timely repayment of loans was given to 1,500 nano entrepreneurs that had been handpicked across UP, Haryana, and Rajasthan. For the same reasons that Priya had mentioned not so long ago. This year, which would be year 2 of our grant giving cycle, we're trying to kind of go up, move up the continuum, so to say, and we're exploring other CSR compliant innovations like a loss guarantee to unlock concessional capital for skilling, along with an incentive for placements. We're also looking at being an outcome funder for an impact bond on sustainable bamboo agriculture and livelihoods via collectives of farmers and women artisans who will together own the end-to-end value chain. So this was just a 2-3 minute background on the portfolio. Needless to say, the opportunity and the leverage that blended finance provides is truly exciting for any CSR. So as the complexities in the development sector continue to grow, it's critical to identify innovative solutions like the ones discussed in today's masterclass. So while conventionally CSR had been grant-based, there is immense potential in the role that CSRs like myself and any other, several others on the call today can play here. Grants provide a key source of capital that is missing in the sector, essentially capital that is risk tolerant, patient, and seeking no returns. So using grants to de-risk transaction and unlock commercial capital is a win-win. It can, amplify or scale impact through increased leverage of CSR funds. And, further instruments like RGs are very, very viable and plug and play. They fit so beautifully into the financial inclusion or the gender empowerment or the livelihoods initiatives that CSRs typically fund. So, simply put, a huge, at least, while pitching this internally, a huge advantage is that blended finance approaches just help stretch your CSR funds further and deliver exponential impact. Kind of highlighting that definitely helped with the internal conversations we were having with stakeholders in the initial years. And of course, you need to convince the internal ecosystem to buy into blended finance, since there are several regulatory and statutory requirements we have to comply with. But for that buy-in, first, you need, as a CSR leader, you need to believe it's going to be effective for your CSR portfolio. So it can be an uphill task of change management, but until you are convinced, you're not going to be able to convince the internal ecosystem of stakeholders. So your approach will also need to be practical. It needs to fit within your CSR agenda. It needs to be aligned with your partners. It needs to be aligned with your strategy and metrics for evaluation and success. I think that's something that Abhinav also touched upon, would apply even for a philanthropic funder. It has to fit within your structure and be practical. We collected third-party opinions to validate compliance. That often helped, gain the confidence of our compliance teams before we embarked on this journey. And needless to say, you have to carry a large set of stakeholders and partners along with you on this journey. So there are going to be many, many, reasons to say no, but many compelling reasons to say yes, some of which I've shared with you today. And with that, I would like to conclude by saying that while blended finance may be at its infancy when it comes to CSR in India, I am confident that platforms like IBFC, forums such as this masterclass, and game changers like the Michael and Susan Dell Foundation, Samrid, Revive, USAID, etc., will continue to pave the way, both on the demand side and the supply side of blended finance innovations in the social sector. And I hope that several of you who have been passive listeners on the call today will join this journey. So with that, thank you, and back to you, Priya.